Most people think they understand the 4% rule, but buried inside it is a surprisingly counterintuitive piece of investment advice that I think many people miss. Specifically, the success of the 4% rule depends almost entirely on how your portfolio is invested. My name is Eric Googe, and today we are going to be looking at the actual research from William Bengen, the at times reluctant author of the 4% rule, to see what it really takes to make your money last for 30 years or more. And before we jump into it, I have a question for you. Do you plan to use any version, or do you use any version of the 4% rule to retire? If you do, or if you don't, let me know in the comments and let's jump into it. William never called this the 4% rule in his literature. That was something that happened much later when the media and so forth started reporting about these findings. It was something that he felt was too specific and generalized. And so he kind of shied away from being considered the author of the 4% rule, because he wasn't trying to necessarily say, hey, look, everybody needs to withdraw no more than 4% of their portfolio. If you withdraw more than that, then bad things will happen. He wasn't trying to say that at all. He was frustrated with the fact that there was no general guidance in the financial planning profession around the question of how much a retiree could safely withdraw in retirement. And so he had to find the answers to those questions himself. He had to conduct the research himself. But as these things sometimes go, he publishes his research, and other people sort of ran with it. But what he was trying to answer was, he was trying to investigate, rather, this idea of sequence of returns risk. We know, for example, that it's not just the level of return that an investor receives in their portfolio that matters, but it's also the order in which those returns happen. And we'll see an example of this here in a minute. But he wanted to know how much an investor could safely withdraw from their portfolio without worry about outliving their money. Some people have used his research to approximate an answer of how much, or an answer to the question of how much do I need to have saved up by the time I retire. But fundamentally, what Mr. Bangen is doing is he is investigating how sequence of returns risks impacts portfolios. So before we go into the actual data, I want to explain the math behind the 4% rule, because if you don't understand this, you'll misinterpret the results. The way the 4% rule works is like this. We'll use an example. Assume a $1 million portfolio that returns 7% on average and 3% inflation. And assume that we are going to withdraw 4% initially. All right, so we have $1 million portfolio. We're withdrawing 4%. That means our first distribution is $40,000. And I think that makes pretty good sense. Okay, so now our portfolio is worth $960,000, but it's growing. So it's going to grow at 7%, and it's going to grow to $1,027,200. In year two, we're not going to take, this is where people get tripped up. We're not going to take 4% of the $1,027,200. Instead, what we're going to do is we're going to simply adjust our distribution for inflation. And recall, we assumed that inflation was 3%. So if we multiply $40,000 by 1.03 to adjust it for inflation, then we have a year or two distribution of $41,200. You repeat this process until the end of your horizon, which is just a polite way of saying until you die. This, by the way, is the same way that Social Security works. When you begin taking your Social Security distributions, each year they are increased for inflation. This is the exact same process that Bengen used in his research. So this research is fundamentally about sequence of returns risk. So what is sequence of returns risk, and what does it look like? And let's walk through an example. Let's imagine we have two retirees and they're going to retire for 10 years. I'm just going to keep this nice and short so it's simple. So they have a 10-year horizon. They are both going to withdraw 4%. They're going to do the 4% rule. They have $1 million portfolios. And in fact, they have the same average rate of return in their portfolios over these 10 years. They will have an average 10% return in their portfolios. If these two retirees did not take any distributions, their portfolios would look the exact same. Both investors would have the same balance at the end of 10 years. Nothing has changed. But if they are taking distributions, the order in which those returns happen begin to matter a lot. So let's assume for retiree one, he gets 20% returns in years 1 through 9, and then a negative 80% return in year 10. So he did great for the first 9 years, and then the bottom just completely fell out of the market, and there was a negative 80% return. Investor two has the exact inverse situation. Investor two has a negative 80% return in the same year that he retires, but then he gets 20% returns in years 2 through 9. So who do you think is better off in this situation? Again, if they aren't taking distributions, they are equally well off. Their portfolios will be the same, but they are taking 4% and a 4% initial withdrawal. So in year one, investor one is going to take $40,000 from his portfolio, and then he's going to subsequently adjust that distribution for inflation. He will end up taking roughly $460,000 from his portfolio. And the value of his portfolio at the end of 10 years will be roughly $800,000. Investor two, on the other hand, is going to take $40,000 in year one, just like investor one, but he's actually going to run out of money somewhere between years 8 and 9. He's only going to end up taking $360,000 in total distributions, and he will have no money left over after that. So clearly, the order of returns is very important, and this is what Bengen was exploring. And the easiest way he could explore this issue was to look at the historical record, because we have inbuilt into the historical record a series of varying returns. We can look at retirees who retired in different time periods, and they will have perhaps the same or similar average return, but the order in which those returns happens will be very different. So William Bengen is interested in portfolio longevity. Okay, so what did the data look like? If we take a look at this graph here, this chart, it's called Portfolio Longevity from 1926, quarter one forward. This is what the data looked like when William Bengen published his original paper. And I want to insert a couple caveats here. This is recreated data. I recreated William Bengen's research. I had access to slightly different returns than William Bengen used. And so there are slight differences that we will see. And I'll point them out as we go along. All of the conclusions about the data point in the same direction. The shape of the graphs are all very similar. It's just that there are small differences in the actual numbers, because the return series that I was using was a little bit different than the return series that Bengen was using. But if we look along the x-axis here, we got retirement start quarter. So each of these bars, these green, blue, and red bars, represent a portfolio beginning in each subsequent quarter. So the very first bar on the left side of the graph there, we can see is a retiree retiring in the first quarter of 1926. And this goes all the way to the fourth quarter of 1976. This is a similar time period to what William Bengen used. He also capped the data at 50 years. So if we look at on the y-axis here along the left-hand side of this graph, we can see 0, 10, 20, 30, 40, and 50. This is how long each of these portfolios lasted. Now, he was investigating how withdrawal rates and asset allocation impacted portfolio longevity. So each of these bars are going to differ slightly. And we can imagine that some of these bars extended far beyond 50 years, but he capped the data at 50 years to reasoning, I suppose, that most people don't need a retirement portfolio to last more than 50 years. And I think that's a pretty strong assumption. But this is what the data looks like. So we got green bars. These are portfolios that lasted a full 50 years. We've got blue bars. These are portfolios that lasted 31 to 49 years. And we've got red bars, and these are portfolios that lasted less than 30 years. Here's one of the differences I want to point out. At a 4% withdrawal rate, none of William Bengen's portfolios lasted less than 30 years. So 30 years was the standard, the threshold, the bar that had to be crossed before William Bengen decided a portfolio succeeded or failed. And I think it's a pretty strong assumption because if we assume a retiree retires at age 65, that would take their portfolio through age 95. So that's a pretty strong assumption. I have some portfolios here in my data that only lasted 25 years, and that is simply an artifact of the different data that I was using. So just know that in Bengen's research, it was 30 years. Here it's 25 years. The shape of the graph is the same though. But this is where 4% comes from. So the reason it's 4% and not 5% or 3% or any other percent is because 4% was the maximum withdrawal rate where all portfolios for all our retirees here, we've got 204 hypothetical retirees retiring at different quarters. All those portfolios lasted at least 30 years. And that is why it is the 4% rule instead of the 3% rule. In Bengen's actual research, he found that I think it was 3.5% withdrawal rate would result in all of these portfolios lasting a full 50 years. So if you're part of the the fire crowd out there, I suppose, the people who want to retire super early, that might be of interest to you. But this is what the graph looked like. So what exactly is the safe maximum withdrawal rate? This 4% withdrawal rate. Bengen created this concept. This concept didn't exist before his paper, but he termed it the safe max, and this is just an abbreviation for a safe maximum withdrawal rate. So 4% is the safe max, and it is the level of withdrawal, the initial withdrawal rate that doesn't fail any rolling 30-year period. It's important to realize here that this is not an average rate. The 4% safe max is not the average rate that a retiree could withdraw from their portfolio and never worry about their portfolio running out. In fact, it has varied widely. We can imagine, for example, a retiree retiring in the first quarter of 1926, being able to withdraw more or less than a retiree retiring in the first quarter of 1950, for example. And in fact, if we looked at this next graph, it's very similar to our first graph. This one's entitled the maximum safe withdrawal rate by retirement quarter. If we look along the x-axis here, we got our retirement start quarter. This one has 200 hypothetical retirements. We cut off here at the fourth quarter of 1975 instead of including 1976. But we can see on the y-axis, instead of how long each portfolio lasted, we instead look at the maximum amount each retiree could withdraw from their portfolio such that it lasted at least 30 years. And we can see that this number varies widely. For example, and as a caveat, again here, this is my recreated data. This is not Bengen's data. His is a little bit different. For example, the minimum safe maximum withdrawal rate in my data is 3.8%. That's clearly less than 4%, but pretty close. So we can see that a retiree retiring in the third quarter of 1932 was able to withdraw almost 12% from their portfolio, subsequently adjusted for inflation, and never worry about their portfolio running out of money. A retiree in the late 60s and 70s, on the other hand, had to settle for a much lower 3.8% withdrawal rate, so 70% less. That is the period that defined the universal safe max. This is the retiree. In fact, it was the fourth quarter of 1968. That retiree was the retiree whose safe maximum withdrawal rate created the 4% rule. Because if Bengen figures if the retiree can withdraw 4% and survive that period, which had the lowest maximum safe withdrawal rates, then they clearly would be able to survive a period in which they could withdraw 70% more, right? That stands to reason. But there's actually a pretty interesting observation of this data, because we notice that the safe withdrawal rates in the 60s and 70s are a lot lower than the safe withdrawal rates even during the Great Depression, which means that in terms of portfolio longevity and safe maximum withdrawal rates, retiring in the late 60s was much worse than retiring even during the Great Depression. And why should that be the case? Well, the reason that is the case is because in the 1960s and 70s, while portfolios were getting hammered with poor returns, inflation was also very high. So you had two things happening in these portfolios. You had, on the one hand, the value of the portfolio coming down, but then on the other hand, the value of the distributions were increasing dramatically over that same time. So both of those things created this situation where the overall withdrawal rate from the portfolio increased dramatically, which subsequently meant that those retirees were unable to withdraw as much from their portfolio as other time periods. In the Great Depression, we had a different situation. In that period, returns were obviously terrible, but we had deflation instead of inflation. So instead of the withdrawals increasing in value each year, we had a situation where the withdrawals were decreasing in value each year. And this partially offset the lower overall portfolio balance, which allowed those portfolios to last longer. And this actually brings an important point in this research, and it's the role of inflation in the maximum amount you can withdraw from your portfolio, or how long your portfolio will last in retirement. It's clear that from this data, investors who retire during a period of high inflation are at much greater risk than investors who retire in other periods, all else equal. So it's not just the returns you get in your portfolio, but also the inflationary environment that you find yourself in during that period. So at this point, you might be asking yourself, is going over the universal safe maximum withdrawal rate over that 4%, is that a bad thing? Well, I would not draw that conclusion. For one thing, most financial planners, and myself included, know that your income and your expenses vary over the course of retirement. For example, most retirees find themselves in a situation where their living expenses are relatively higher at the beginning of their retirement relative to later periods of their retirement. So as they get older, their living expenses decrease. In Mr. Bangen's research, he's assuming that we are simply adjusting our distributions for inflation each year. So the real value of those distributions is fixed each year, and they are going to increase dramatically if inflation is really high. But the reality is that that's usually not the case for most people. And the way most financial planners tackle this question is they don't necessarily look at the withdrawal rate when a retiree enters retirement to judge whether a portfolio is at risk of running out of money or not. Instead, what they do is they ask, how are your income and living expenses going to evolve over retirement? For example, many retirees enter retirement not having yet collected their full Social Security amount or filed for Social Security. Perhaps only one spouse is collecting Social Security, and another spouse is going to begin collecting Social Security at a later age, perhaps 70. This will increase their income, which all else equal is going to reduce the amount that they need to withdraw from their portfolio. So we can imagine a situation where a retiree enters retirement at a 9 or 10% initial withdrawal rate. That doesn't necessarily make me nervous because I know that we are not going to simply adjust that withdrawal rate for inflation each year. Instead, we are going to account for further increases in income. Perhaps it's Social Security, perhaps it's an inheritance, but we're also going to try to map out those future expenses. So if you are way above this 4% figure, I don't think you should be concerned. Just know that this figure is based on a very conservative assumption, which is that your distributions will simply increase with inflation each year, which is not necessarily the case. So now you might be asking yourself, does the 4% rule work independently of asset allocation? And the answer is that it absolutely does not. And in fact, I see this misinterpreted online a lot. I've seen, for example, people talk about the 4% rule in the context of a high yield savings account, which is just cash. In Bengen's research, he did not define the 4% rule or the universal safe maximum withdrawal rate independent of the asset allocation in the portfolio. In fact, that was another variable that he played with to see how they impacted different allocations impacted portfolio longevity. In his original paper, the standard portfolio that he uses is a 50% stock and 50% bond portfolio. But he actually looked at, I believe it was five different portfolios, and these are a 0% stock, 100% bond portfolio, 25% stock, 75% bond portfolio, 50/50, a 75% stock, 25% bond portfolio, and then a 100% stock portfolio. So, in order for the 4% rule to work, Bengen actually found that there was a sweet spot between 50% equities to roughly 75% equities. I'm going to show you exactly what I'm talking about here. But the point is that 4% is not independent of asset allocation. In fact, Bengen concluded that a minimum equity allocation of 50% was justified if you were going to retire according to the 4% rule. And he didn't really ever advocate for allocating more than 75% to equities because below 50% and above 75%, and I'll show you an example of this here in a minute, he found that the maximum amount you could actually withdraw from the portfolio actually starts to taper off. So 50 to 75% was sort of the sweet spot that Bangin targeted. I don't necessarily, you might take that data point and ask yourself, well, does that mean I need to have 50% to 75% equities? And I don't think that's a good conclusion you should draw. In fact, I don't necessarily take these findings at face value because the reality is there's a lot of ways that planners, financial planners, decide the asset allocation for somebody entering retirement. And Bengen's research, these retirees entered retirement with a relatively fixed asset allocation. If you retired at age 65 with a 50/50 portfolio, in many cases, he assumed you would keep the 50/50 portfolio through retirement. You would just continuously rebalance. There were some variations on that he included in later research. For example, he included a variation where a retiree actually reduced their allocations to equities by 1% for each year in retirement so that, over time, their total exposure to equity decreased. But for the most part, these were fixed allocations. But a lot of planners approach this in a different way. For example, A very common approach is to ask what your annual living expenses are. How much will you need to be withdrawing from your portfolio each year? And I'm going to use an example here. Let's say you need to withdraw $100,000 from your portfolio each year. And let's say you have $1 million portfolio. Well, what a lot of planners will do is they'll say, okay, well, we want to have perhaps 3 or 5 years of living expenses in relatively stable investments, right? So that we're not forced to sell off equities during a bear market to fund those living expenses. So they might say, let's put 3 years of your living expenses in fixed income. And if you have $100,000 in living expenses that you need to withdraw from your portfolio, that would be $300,000, right? You have $100,000 in 3 years of living expenses. Well, that means your asset allocation would be 70-30 in that situation. And we can imagine if you had a much larger portfolio, you might have a 90-10 asset allocation. It really varies, but they don't target, a lot of planners don't target an equity allocation based on the safe maximum withdrawal rate. Instead, they ask how much do we really need to be pulling from this portfolio, and then start with fixed income and then fill in the equity allocation. A variation on this is to use something called a bond ladder. In this situation, what a lot of planners will do is they'll say, okay, we know we need $100,000 next year or this year. Let's put that money in a money market fund. And we know that the following year we'll need another $100,000. So let's put that in 2 year bonds maturing in 2 years so that they're maturing when we need that money. And then we know the following year we'll need another $100,000. Let's put those in 3 year bonds so that they mature when we need that money. And then what they'll do is that as you work your way through that bond ladder, they will sell off equities to build the bond ladder back up. The longer your ladder, the more flexibility you have in deciding when you want to sell off those equities to replenish your bond ladder. For example, if you have a 5 year bond ladder and in the first year equities sell off dramatically, you might reason, well, I don't think that this is equity sell off is going to last all that long. How about instead of rebuilding my bond ladder this year, I wait another year. I still have, 2 or 3 years of ladder left before I need to sell off equities to replenish the rungs, so to speak, on that ladder. So I'll just wait another year. So the longer the bond ladder, the more sort of flexibility you have in waiting out a bear market. So that's sort of a variation on the fixed income method that I talked about. Another method that a lot of planners use is what's called a glide path. I talked about this really briefly with Bengen. One of the variations to the asset allocation approach that he used was to assume that investors would reduce their equity allocation by 1% for each subsequent year in retirement, right? Some advisors do something similar to that, where the equity allocation is gradually reduced over retirement. That's why it's called a glide path. Some advisors take the exact opposite approach. And actually, there's some interesting research around this where entering retirement with relatively high allocations to fixed income and then increasing your allocations to equities as you progress through retirement actually might be more optimal. And the reason is, if we go back to our discussion about sequence of returns risk, we know that it's those early returns that really impact how long your portfolio is going to last. Remember in our example, that second retiree, he got hit right up front in year one with a negative 80% return, and that substantially reduced how long his portfolio would last, right? Compared to investor one. So the idea here is that you can mitigate sequence of returns risk by having a more conservative allocation in those early years of retirement, with the idea being that, look, if markets are bad when you enter retirement, you will be better off, and then you can sort of dollar cost average into equities as equity markets rebound and you progress through retirement. And if markets are good when you retire and you have a high allocation to bonds, it won't really matter anyway because markets were fine and your portfolio is likely to be fine Anyway, so it's sort of putting a floor underneath that downside scenario when sequence of returns risk is elevated in those early years of retirement. By the way, if you are interested in learning about, that's called a rising equity glide path. If you're interested in that topic, there's a really good research paper written by Michael Kitces. It's entitled, "Should Equity Exposure Decrease in Retirement, or is a Rising Equity Glide Path actually better?" I highly recommend you check out that article because it talks exactly about that. Okay, so going back to asset allocation, that all of that was just to suggest that there are different ways we can approach asset allocation as we enter retirement. But let's take a look here at this next chart and look at how our equity allocation impacts our safe maximum withdrawal rate. So this chart is entitled Maximum Safe Withdrawal Rate by Allocation. This is again using my data. So full disclaimer on that. Mr. Bengen's data looks slightly different, but the shape of this graph is the same. The level is just a little bit different. But along the x-axis, along the bottom here, we've got different equity allocations. So you can see I've got it broken up into deciles here. So 0%, 10, 20, 30, 40, 50, and so on. Equity allocations. And then along our y-axis, we got the safe maximum withdrawal rate that equity allocation would support. If we recall those earlier graphs, we were assuming a 50-50 portfolio. And actually, in the second chart we looked at, we were assuming a 60-40 portfolio. But for all intents and purposes, we were assuming roughly a similar mix between stocks and bonds, and then asking how does the withdrawal rate or the time you retire affect the safe maximum withdrawal rate. Here, instead, we're asking how does the equity allocation impact the safe maximum withdrawal rate. So again, I'll repeat this. Instead of looking at how the time period or the withdrawal rate impacts the safe maximum, the safe max, we're looking at how the equity allocation impacts the safe max. And this is actually an interesting graph for a couple of reasons. For one thing, you'll notice that if we move up into the equity allocation, we have a rising line here, right? So clearly adding stocks to the portfolio is increasing the amount that we can withdraw from our portfolio. But we reach a point around 50 to 60% stocks where that quits increasing and it kind of plateaus. And then beyond that, it actually starts to dip again. So what's going on here? We can see that with a 100% equity allocation, we have a 3.1% maximum safe withdrawal rate, whereas at a 60% equity allocation, we have a 3.8% withdrawal rate. And in fact, between 60 and 80%, the maximum safe withdrawal rate is about the same. So this is interesting because it points to a really important principle in investing, and that is the principle of diversification. We can see that if you have a very concentrated portfolio of 100% stocks, the amount that you can withdraw from your portfolio is actually less than the amount you could withdraw from your portfolio if you introduce some bonds into your portfolio. So, what is it about bonds that increase your safe maximum withdrawal rate? Well, for one thing, we know that bonds have relatively lower returns, right? And that might lead you to believe that, if anything, bonds reduce the amount you can safely withdraw from your portfolio. But that's not the case because it's not that bonds have lower returns or less volatility. That's not the reason why we're able to withdraw more from portfolios in retirement by adding bonds. The reason is that the bonds have a relatively lower correlation with equities. So you can imagine when equities are selling off, bonds might be increasing or maybe not selling off as much, or perhaps just moving sideways. And I want to be clear about this. There are many different kinds of bonds. Bengen was using intermediate term government bonds. I'm actually using a long-term government bonds data series. That was the only data series I had access to. But there are many different kinds of bonds. There's corporate bonds, there are municipal bonds, there's bonds with options attached to them, there are high yield bonds. All these bonds, these different types of bonds behave very differently, but largely as an asset class, bonds exhibit low correlations to equities. And it's this feature of bonds that allows you to increase the amount despite the added investment being getting a lower return. You're adding bonds, and their bonds are likely to get a lower return. Despite that, you're actually able to increase instead of decrease the amounts that you can withdraw from your portfolio, which is very interesting. Another interesting thing that we can see by looking at this graph I mentioned earlier is that between 60 and 80% equities in my data, and I mentioned earlier that Bengen found between 50 and 75% equities, so pretty close. There doesn't seem to be much of an increase in the amount an investor can safely withdraw from their portfolio. And what this tells us is that investors have, it appears to have a large degree of discretion in deciding how much equity they want to have. So it's not the case that you need to find the optimal equity allocation. There's actually a pretty substantial range. I think what's most important is that you have at least some equity, but not too much equity. And so that's helpful to know because you're not trying to find the exact optimum necessarily. You don't have to beat yourself over the head trying to find that optimum. That's going to be a backward looking exercise anyway because we have no idea what returns are going to be, but you do have a range, you do have some discretion in deciding how to allocate your portfolio in retirement. And I do want to mention just one more thing about diversification. So I mentioned earlier that adding bonds, despite their lower returns, increase the amount that a retiree could withdraw from their portfolio in retirement, despite again getting lower returns because they had lower correlations with equities. The same is actually true within the equity asset class itself. And Bengen himself, over the years, has increased the universal safe maximum withdrawal rate, that maximum level that any retiree could withdraw and not worry about exhausting their portfolio. It was 4%, I recall, in the first paper. He later revised it to 4.3%. And the key reason that he later revised it was that he added small cap equities, small capitalization equities. These are smaller companies to the equity mix. So he didn't change the percentage of equities in the portfolio. Instead, he just added small caps within the equities. Later, his most recent research, in fact, he just this past year published a book, I believe it's called A Richer Retirement, I believe. He added mid cap stocks. He kept the small cap stocks, of course, and the large cap stocks. He added micro cap stocks. So these are companies that are even smaller than small cap stocks. He added international stocks and he added T bills. And when he did that, this is now a seven asset class portfolio instead of a two asset class portfolio. When he did that, he increased the safe maximum withdrawal rate to 4.7%. So we can see that adding more asset classes increases the safe withdrawal rate. And the reason is not because those asset classes necessarily get higher returns. The reason is because they have varying degrees of correlation with our existing portfolio. And the more uncorrelated we can get those additional asset classes to be, the better off your portfolio is going to be in terms of volatility, but also clearly in terms of how much you can safely withdraw from your portfolio retirement. Okay, so that is asset allocation. Now I want to turn to this question of taxes because this is another big misinterpretation that I see when people talk about the 4% literature, and it's ignoring the impact of taxes. Began found himself in a difficult situation with his research. It's very difficult to study the effects of capital gains taxes, for example, on a portfolio because it depends entirely on when you bought certain securities and when you're selling them and withdrawals and rebalancing. And there's just a lot of factors. For tax deferred portfolios, which most of his research focuses on, so these are things like IRAs, 401ks, Bengen assumed that taxes would be paid with the withdrawal. So 4% includes the taxes on those withdrawals. All of your living expenses are after tax, of course, right? Or most of your living expenses are going to be after tax. So if you are going to estimate how much you can safely withdraw from a tax deferred portfolio using the 4% rule, you're actually going to overestimate a little bit if you do not include the impact of taxes, because you're going to have to withdraw to meet your living expenses, but then you're going to have to also withdraw to pay the taxes for those living expenses. And in practice, a lot of people have taxes withheld from their tax deferred withdrawals in retirement. So that's going to reduce the amount of the withdrawal that ends up in your bank account. So don't make the mistake of simply assuming that since your living expenses are 4% of your tax deferred retirement balance, retirement portfolio balance, that you can safely withdraw that and you'll be fine. You'll end up actually having to reduce or withdraw more than that amount to meet your tax burden. He also found, and this is not surprising at all, that the safe withdrawal rate in taxable portfolios is lower than the safe withdrawal rate in tax deferred portfolios. And this makes sense because there's a tax drag that happens each year with tax deferred portfolios, right? The calculating the impact of those capital gains taxes, as I mentioned, is very difficult, very nuanced. He did find that the safe withdrawal rates were lower for tax deferred portfolios, but on an after tax basis, the after tax investor, or sorry, the taxable brokerage account, the investor using a taxable brokerage account actually comes out ahead, which makes perfect sense because the tax deferred investor is paying taxes on his entire withdrawal, whereas the investor using a taxable brokerage account is only paying taxes on his capital gains. So he's not paying taxes on the entire withdrawal, just a portion of it. So on an after tax basis, he comes out ahead. That's just a little wrinkle, a little nuance, but I did think it was relevant to bring up because most people have a combination of taxable and tax deferred assets. And that is something you might want to, if you plan on using this rule, to consider and perhaps add a small buffer to account for. There was a paper he wrote in 1996. I will include it here after I find the paper. But because I'm blanking on the name of it, but he explored this issue and showed the actual safe maximum withdrawal rates for taxable brokerage accounts under different assumptions. Okay, so we've covered a lot of ground here. William Bengen is still alive and he's still updating his research. In fact, I just corresponded with him via email while I was prepping for this video. I was trying to get his data so that my charts would match his charts, but of course, he's using licensed data, and I was unable to acquire that. But in any case, he's still updating his research. I mentioned he just published a book this year, and the approach he takes has departed slightly from the approach he took in his initial research. Particular, the safe maximum withdrawal rate that he advocates for. I already mentioned that we've increased it to 4.7%, and that was just by virtue of the fact that we added more asset classes. We had more diversification that increased the health of the portfolio. But he also has taken a different approach to deciding which safe maximum withdrawal rate to use. If we hop back over to the safe maximum withdrawal rate by retirement quarter, we note here that there are many different safe maximum withdrawal rates that depend on the quarter in which you retire. Recall they fluctuate as high as nearly 12% for someone retiring in 1932 and all the way as low as 3.8% in my data, but 4% in Mr. Bengen's data in the later 60s. So what William Bengen is trying to do now is say, okay, well, can we refine the assumed safe maximum withdrawal rate for a retiree if we make it conditional on the current inflationary environment and the current valuation of the stock market? And I think this is a little bit of a riskier approach if you stick to the philosophy of this research. So the implicit assumption with the original research was that future will be at least no worse than the past, right? If a 4% withdrawal was good enough for a retiree in the fourth quarter of 1968, if we assume that conditions will be no worse than 1968, then you will be good. But here, we're not just assuming the lowest point across any of these different trials. Instead, what we are saying is what is the safe maximum withdrawal rate condition on the fact that inflation is at a certain level and the stock market is being valued at a certain level. And I'll break down the reasoning here. So, within his newer research, Bengen finds that if we break up the inflationary history into three possible inflation regimes, we have a low inflation regime. I believe this was 0 to 2.5%. I might be a little bit off there, but I believe that's what it was. A moderate inflation regime, which I think was 2.5 to maybe 3.5 or 5%, and a high inflation regime, which was inflation rates higher than that. If we broke the history down into those chunks, we get a pretty clear pattern if we also account for the valuation of the stock market. So we have three possible inflationary regimes that you can retire in. You could find yourself retiring in the late 60s and you'll be in the high inflationary regime, or you could retire in the Great Depression and be in a very, very low inflationary regime, right? The second component to this is the valuation of the stock market. And the reasoning here, I think he assumed that when the stock market was being very highly valued, there was an increased risk in future market sell-offs. And the way he measured the valuation of the stock market was with a measure that's called the Shiller Cape ratio. And this is a price to earnings. It's CAPE stands for cyclically adjusted price to earnings ratio. So it's a PE ratio is what it is. But instead of just saying what's the PE this year, it takes the average earnings over the last 10 years, I believe it is, and says what's the PE based on the last 10 years of average earnings. It's a smoother way to evaluate the current stock market valuation. So I'm going to repeat this. He is assuming that when the CAPE ratio is high, like it is right now, for example, or like it was during the dot-com bubble, that there is an increased risk that an investor will face a market sell-off early in their retirement. So what he did was he said, okay, if the Shiller Cape ratio is at X multiple, it's at this multiple, and you are in this inflationary regime, here is the safe maximum withdrawal rate that historically you would have been able to withdraw from your portfolio. So I don't have the actual data here, but let's assume a Shiller Cape ratio of 30. So right now the Shiller Cape ratio I believe is higher than 30, but let's just assume 30. And let's say inflation is 2.5%. What Bengen would do is he would say, let's go back in history and find a period of time within a that inflation regime, within the 2.5% moderate inflation regime, where the Shiller Cape ratio was near the level that it is right now. What was the safe maximum withdrawal rate for that retiree? And then he uses that figure to be the safe maximum withdrawal rate for the current retiree. So it's a little bit more dangerous. It's less, perhaps not dangerous isn't the right word, but it's far less conservative than his original approach because the safe maximum withdrawal rate is now conditioned on two pieces of additional data. And so it relies on the historical pattern to repeat according to those two additional data points, right? So it's not just that, in the history, this was the worst time period and this withdrawal rate worked for this time period. So as long as we're not below the worst period in history, we'll be okay. It's no longer that very conservative assumption. Instead, it's okay, well, as long as history plays out like it did, or as long as the future rather plays out like it did in the past, according to these two additional variables, then this is the safe maximum withdrawal rate. All that is to say is that he's adding two additional variables to advocate for a safe maximum withdrawal rate, which is a little bit less conservative. But let's talk about the major takeaways from Bengen's research. I think the first major takeaway and the easiest one is that diversification increases how much you can sustainably take from your portfolio. That is true in uh, in the theoretical financial research. If we think about in theory, that is true, but it's also true in the historical record, and so it paints a very strong case. There are a lot of young accumulators, a lot of young savers, people who are nowhere near retirement age, who have benefited from very concentrated portfolios. For example, we can think about the world's billionaires. A lot of them had almost all of their net worth tied up into very concentrated equity positions in their companies, right? Or you can imagine somebody who just hits it out of the park with a really good stock bet. There are a lot of people who have benefited from concentrated portfolios when they're younger. And I'm not advocating that you necessarily should concentrate your portfolio when I'm younger. That's when you're younger. That's not what I'm saying. What I'm saying is that that has been the case, and it is plausible that it will continue to be the case for some people going forward. We just don't know who those people are going to be. But what is clear is that for retirees, it is not true that concentration in your portfolio increases how much you will be able to sustainably withdraw from your portfolio. The opposite isn't true. In fact, it's when you reach or are approaching retirement, this is when diversification becomes even more important. And we see this a lot with a lot of sort of rule of thumb guidance handed out online. For example, we know that younger investors benefit from having more concentrated portfolios in equities, for example, right? Like a 30-year-old investor would benefit from having a 90 or 100% stock portfolio, for example, of course, diversified across different asset classes within that stock portfolio, but they would benefit from that versus having a 60-40 portfolio. But that is no longer the case when it comes time to withdraw from that portfolio. And the reason it's no longer the case is because of sequence of returns risks. We go back to our original discussion about sequence of returns risk. Recall that if you're not withdrawing any money from your portfolio, it doesn't matter. Sequence of returns risk does not matter. You will end up with the same balance regardless of the order of your returns, as long as the average level of returns is the same. But once you begin withdrawing from your portfolio, that is when sequence of returns risk comes into play. And that is when you need to focus perhaps more acutely on diversification, right? So that's the first major takeaway. The second major takeaway is that there's probably no optimal equity allocation that you can figure out going forward. It's certainly a backwards looking exercise, but there does appear a large degree of discretion in how much equity you actually allocate in your portfolio. Recall that we saw when evaluating the safe maximum withdrawal rate according to different equity allocations, there was a plateau from about 60% equities to 80% equities, where adding more equities didn't benefit how much you could withdraw from your portfolio, and having fewer equities it was certainly detrimental to the portfolio. Put another way, having too much equities was bad for the portfolio, and having too few equities was bad for the portfolio. But there was a pretty substantial 20 or so percent equity allocation range there where investors had similar outcomes. So it's clear that there's a degree of discretion that investors have when deciding how much equity they want in their portfolio. And just as a reminder, that's not the only way. Looking at the safe maximum withdrawal data is not the only way to decide how much equity you want to have. There's other ways to do it. For example, considering your living expenses and then figuring for your fixed income allocation and then working backwards into your equity allocation. That's a viable way to do it as well. Or using a bond ladder or a glide path. Those are all viable ways. But there is a degree of discretion there. And then the final takeaway here is that sequence of returns risk is a major risk, and you need to have a plan to address it. There are several ways to address it. You can do it with your asset allocation, but you also might consider, and I don't, think you need to definitely plan on this, but you might consider also the effect of a soft retirement. A soft retirement is retiring from your full-time job, but giving yourself the option to step back into the job market on a part-time basis if the first few years of returns are particularly bad. Again, I'm not saying you should definitely plan to do this when you retire. Everybody's situation is different. But I do think having the option to do that and planning well in advance for that option will give you some more flexibility in directly addressing the sequence of returns risks. Because, of course, if you step back into a part time role because the stock market is selling off steeply and inflation is very high, you're going to be reducing the amounts of money you need to withdraw from your portfolio. And so you might buy yourself a little bit of flexibility in that regard. Okay. I hope you found this video about the 4% rule interesting and useful. If so, I would greatly appreciate it if you would share it with your friends and family, or give me a like and subscribe so that we can reach as many people as possible with this quality financial content. Till next time, my name is Eric Gouge. I am a chartered financial analyst. I am a certified financial planner, and I am the owner of Uvest Advisory. Thank you for watching.